Now it's time to bring back in my good friend and co-host, Jeff Small, as well as another good friend, Dave McAdams, president of McAdams Group, a retirement income store located just outside of Memphis. Dave, thanks so much for being back with us here on The Income Generation. So 2020 was a write-off for a lot of people. Now we're into 2021. What's the sentiment that you hear from the folks in Memphis? Are people pretty optimistic moving forward, financially speaking, or how are they feeling?
Well, that's a coin toss. It depends, because you have both sides. You have the people who are, basically fear-based. They're concerned about what I would call legislative risk. They're concerned about rising taxes. They're concerned about losing jobs overseas. They feel like a recession's imminent. And then you've got the eternal optimists. You got the people who just believe that no matter what happens, the stock market will keep going up, up, up without any repercussions. So I'm hearing both sides. If you're asking me what I'm hearing from clients, there's the polar opposites is what I'm getting.
Yeah. So Jeff, which camp does Harry Dent fall into?
Harry Dent falls into perma bear camp, because he's constantly predicting every year when the market's going to crash and what happens. And
he falls into his own camp. That's right.
He falls into his own camp. So Dave, I'm starting to feel like my taxes are going to get increased. Are you getting that feeling? Because I think this blue wave is going to become reality shortly here. And so what?
I agree with you. I agree with you. I've been consulting with clients on tax issues going into the end of the year, and one of the things I've been saying is you're probably likely never to see taxes this low for the rest of your life. We had some people that were trying to rush to get some capital gains and some assets sold in 2020 just to take advantage of the lower capital gains rates, which are likely to increase with. And that's why I was referring to the legislative risk. I do believe that taxes will be higher. I don't know when they're going to implement that, but they've even been pretty blunt in saying they're going to be raising taxes. So absolutely, I think that's definitely on the horizon.
And
go ahead, Jeff.
By raising taxes, if they raise corporate taxes, do you know what that does to the market charts we've got already? It makes them look worse, because the earnings ratios drop because now corporations are paying more in tax and keeping less profit. And so that makes stocks look even more overvalued, Dave.
Well, I'm going to have to agree with you. I think economic policy, when you look at the different things that the government can do, one thing they can do is lower interest rates. But the other thing they can do is implement economic policy. Now, normally that takes a little bit longer to sink in as far as having an economic impact. But to your point, if we raise corporate taxes, you'll probably see corporate funds expatriate. Famously, companies like Apple and other companies had billions of dollars sitting in Ireland just because of the corporate tax rate. They repatriated that money after the 2017 Tax Act. But I would expect that to leave again. I would expect to lose jobs. And I would expect to have lower wage migration. Less increases in wages means less money in people's pockets, which means fewer corporate earnings. All of this does not bode well for stocks having a unlimited run.
And David, we need to take a commercial break, but we're going to come back and we're going to talk about interest rates and what you think is going to happen there. So stay with us. We have a lot more coming up in just a moment from Dave McAdams. We'll be right back. Welcome back to The Income Generation. I'm David Scranton, and I'm here with Jeff Small and Dave McAdams, president of McAdams Group, a retirement income store located just outside of Memphis. So Dave, being a CPA and all, the joke about a two-handed CPA, right? On the one hand, but on the other hand. So when I hear you talking about the market, I hear you saying, well, on one hand, you think that the increase in corporate taxes should cause the market to drop. But on the other hand, you're saying that don't fight the Fed. How do you think that nets out throughout at least 2021?
I talk about on my radio show a lot that in theory, we really probably should have seen a W-shaped style recovery after the COVID crisis. But we talk about don't fight the Fed. If you look at the economy from 2008 to 2016, the economy was actually very stagnant. GDP growth was non-existent. We didn't have any wage migration. We were losing jobs overseas. But if you look at that period, the stock market went up, up, up for 8 years. Well, there was a magical combination, and it was called 0% interest rates and unlimited government stimulus. If you're going to put interest rates at zero and people get tired of making zero on their cash at the bank, they look at their bond mutual funds and their 401k plans, and there's very little, or if any, growth, there's no income. People get tired of making zero. They look at the stock market going up and they want to jump in. We call it FOMO. FOMO stands for the fear of missing out. So now you have more and more people adding money to the stock market, regardless of irrational pricing or valuations, because in some respects, it tends to be the only game in town. Now, it's not literally the only game in town. There's other asset classes.
But people think it's the only game in town, even though they might not be correct. Exactly.
Yeah, they're just going to pump money in because fear of missing out and tired of making zero at the bank.
Yeah. Jeff?
So what do you think about interest rates, Dave? You just brought up a really good point. 0% interest rates were the reason for the bull market the last 10, 11 years. You know, I see rates staying low for a very long time. I don't see them really going within a 100 basis point range plus or minus from here because the government debt is just too large. We can't afford to service that debt. But debt maximums are reached everywhere in corporate America and with the federalized deficits globally and domestically and with consumer debt. So where do you see rates going in the future?
I agree with you because, you know, when the Fed comes out publicly and says we're not likely to raise interest rates for at least 5 years, translation, that could be much longer than 5 years. I remember back in 2009, the Fed chairman at the time said they were going to raise interest rates by April of 2010. Not only did they not raise interest rates in April of 2010, but 7 years later, they raised them a whopping 0.25%. So you can't always listen to what they say or believe what they say. But when they're bluntly saying they're going to keep interest rates at zero for at least 5 years, my translation is possibly 10 years or longer.
Yeah, so let's talk about COVID-19, this crisis. It's affected investors, it's affected everybody, employees, it's affected businesses. You know, how has it affected your business, your clients? I mean, we saw the 10-year Treasury yield go from being almost 3 down to being under 1 like that. And how does that affect your business being an income specialist?
You know, fortunately, we're very blessed because we'd already made the transition to investing for income. So, for example, when the Dow Jones dropped 38% in 3 weeks, the S&P 500 was down about 35%. There was massive selling all over the country and frankly, globally. Our clients were sleeping pretty well because they understand that investing for income, if price drops, it doesn't mean that income drops. So if you want to be a retiree and sleep at night, if your assets are properly positioned, you don't have to worry about recessionary cycles, big market drops, because just when there's a drop in the stock market, it doesn't mean that your income drops. And that's a big difference in investing for growth and having to rely on growth and relying on having to sell shares to get money versus having more predictable income from interest and dividends.
30 seconds left, Dave. What's your best advice for those joining us today here on the Income Generation for 2021?
Well, I'd say if you're 30 years old, put blinders on, add money, dollar cost average, and revisit this later in life. But if you're retired, my advice is Mr. Market has given you a gift. It's back, it's above all-time highs. It's a great opportunity if you haven't already made the shift for investing for income to consider some portion of your portfolio be properly structured to secure some income first. And then if you want to take risk with some bucket of money, that's a different story. But I would secure that income. The market's given you a gift and an opportunity to do that.
David, that's great advice. And as you know, most of those joining us are part of the Income Generation. So as usual, fantastic advice. Thanks for joining us.
Right.
You stay with us. We'll be back in a moment with more coming up on the Income Generation. I'm David Scranton, and we'll be right back.